I'm super excited about this interview. I want to kind of give everyone a little bit of an insight on who you are, Michael. And again, I'll be more than happy to kind of get some background on you as well. But ladies and gentlemen, we're speaking with Michael, and Michael lives in Nashville, Tennessee, along with me. So he's an acquaintance that I met, and a friend of a friend, and Michael and I had some business dealings together about a year or so ago. And through those discussions, we had some breakfast together. We started talking about it, and I realized that Michael knows a lot more about insurance than I do. And what's cool is May at Real Life Trading is Health and Wellness Month. And I figured it'd be a great time to step out of our normal interview schedule. Normally, we talk to day traders, stock traders, and financial investors. Michael is actually studying with me to learn more about day trading and swing trading in the stock market. But he has a really good perspective, thoughts, and a phenomenal teaching style as it comes to insurance products. And I figured I would just ask you a bunch of questions, Michael, because I know we had breakfast. I was like, hey, man, let me do an interview with you so I can just ask all the questions that I have so that I can learn from you. And he allowed me to do this. So thank you for your time.
Absolutely. My pleasure, man. Thank you for having me.
Yeah. So just give everyone a little bit of background on who you are, man. What's your specialty? How long you been doing it? Give us all that good stuff.
Sure. So my name is Mike Mercurio. I'm the Vice President of Stephen & Associates Financial Advisory Firm. We are a strategic wealth advisory firm. We have been doing this for 24 years. I have been specifically with this firm for 5 years. We create systems of strength, liquidity, and growth that enhance people's finances, enhance their investments, enhance their investment opportunities through protecting, saving, and growing their wealth. We work on every single component of a person's financial world, and that it does include all the insurance components. So I am licensed in all the insurance components so that I understand it well as working through growth components. The one thing I've not messed with in the past is day trading, which is kind of one of the things that's great to watch this. I've been watching you guys this morning, and it's fascinating to watch.
Yeah, man, absolutely. And again, so that everyone's 100% clear on this, I always like to be very upfront, very focused. Michael did not pay me to be here. I did not pay him to be here. I'm simply interviewing and asking him questions because I know when anyone hears the term insurance and stock market, people are automatically like, wait a minute, there's a multi-level marketing scheme going on here. Someone's going to take my money. I really want to learn more about just all kinds of wealth building products. And like I said, Michael and I did some business together. I did have a policy with him for some things I needed. And as we were going through some things, he was asking me more about what I do. And I was kind of telling him and instructing him and giving him some insight and kind of back and forth, vice versa. So one of my initial questions, I just want to kind of dive right into it. We were talking about this weird thing where you told me that you can buy stocks using term insurance, or there's a possibility. So that's my first question is how can you buy stocks with term insurance, or can you?
Okay. So specifically with a standard term policy, just a traditional term policy, no, you cannot. There are multiple types of policies. There are 4 main types of insurance policies, life insurance policies. There is the traditional, just standard term. There is 2 types of universal life. There's variable universal and indexed universal. And then there's what's called whole life or permanent life. So you have variable and index, that's right.
All right, I'm not spelling that right, I'm sure, but permanent, universal, index, universal variable, and term.
Correct.
Okay.
So traditional term policies, no, you pay a premium, you get a death benefit on the books for a period of time, hence term. Universal and variable life both are built on a term chassis, but it allows you to build a cash value within it. Universal, as you hear after that index funds, they often use index funds and take your cash value, put that cash value into some index fund, and as the index fund grows, that cash value grows. If that index loses, you do not lose. Normally it's pretty small growth, but it's growth nonetheless. And they'll typically have a minimum growth amount, say 1%. So it can't earn less than 1%. In those policies, the cash value you can take in either a variable or universal variable or index, you can take and use the cash value. You can take a loan against it to use outside of the policy. It can affect the policy. Variable universal allows you to directly use the cash value in the policy to invest. And then the final option, the permanent policy or whole life, you do build a cash value in that as well. And it is what it's called, permanent. There is a death benefit on the books permanently, and you can actually reuse the cash value. You can get tax-free dividends, income tax-free dividends. There's some additional options with that.
Okay.
That's kind of overview.
Yep. Good overview. And so with these four main, which one is closest or similar to the whole infinite banking concept thing?
Infinite banking, there are many different programs that look at using life insurance as an investment tool or as a piece of the investment tools. And that would typically be whole life.
Got it. Okay. So that's normally that's what that aspect is. Okay.
Right.
So with term, I mean, I know the pros and cons, and this is always like a fun-filled argument with a lot of people is, do you choose term versus whole? What are your opinions and why?
Okay. Well, it depends on how deep we really want to dive into this, but there is a use for term. There is a use for permanent. It depends on what you're trying to do. In my opinion, I think whole life and permanent life is some of the best life insurance you could possibly own. And the reason being, it is the largest tax-free asset you can buy. The whole purpose of building money, making money, saving money, investing money is to have money later on. And with permanent policies, you actually create a cash value that builds with the policy. There are many guarantees inside of a permanent policy. You have a guaranteed death benefit on the books. It's a tax-free death benefit. You have disability protection, oftentimes as a rider, oftentimes as a free rider in it. So if you become disabled, the policy continues to get paid for and continues to grow the cash value, even if you're no longer able to work. Mm-hmm. There are benefits inside the policy, such as a guaranteed rate of return. Often long-term rates of return internally on a permanent policy are somewhere between 4 and 6%. You have access to that fund. It is liquid. You can get it normally within the next day and have access to it to use.
And it's tax-free, right?
If you take it as a loan, it is tax-free. And because you take it as a loan, you can also, under current tax law, you can write it off as a business expense and therefore write off all the interest on the loan. You don't have to pay it back either. If you die, the death benefit that comes in will pay minus the amount you owe on the loan. Mm. If you want to pay it back, you can. Or if you just want to service the interest and write off the interest, right, you can. So it gives you a different options.
Got it. So I want to pause here for just a moment into the interview and just let everyone know, this is my magic secret for how I learn stuff. I want people to know that. A lot of people will ask me, like, how do I learn anything? And how do I know a lot about whatever particular thing? I just go and ask people and have them tell me, and then I just take a bunch of notes and I just kind of write things down. I'll hear things over and over, but I go ask experts or people who've been doing something for a long time, and I am not afraid to look stupid or feel dumb. I just ask questions that I have. So here's another one. With all of that being said, can your cash value that you're building up be taken in a lawsuit if you're liquid?
No. So in most states, no. There are some exceptions, very, very few states, but there are multiple benefits to the cash value in a life insurance policy as well as the death benefit. Cash value in most states is not attachable to lawsuit. So if you get sued, they can take other assets, but they cannot typically take the cash value in it. So you have additional benefit there. Creditors cannot attach in most states to your cash value. You cannot take it. And in most states, it's also bankruptcy exempt.
Oh, interesting. I didn't know that. Okay. So what about in a situation of like term? I mean, there is no cash value in term, so there's nothing for anyone to take, right?
That is correct. Term is basically you're paying a cost. Term is more there's okay. Term I consider death insurance. Permanent I consider life insurance because you can use the money while you're alive. You can do many things with the policy while you're alive. It's an insurance that you can use while you're in existence.
Got it.
Term, it's just death insurance. You're paying a premium to have a death benefit on the off chance that you happen to die within that period of time. If you don't die within that period of time, congratulations, you won, but you also lost any of the cost on the insurance, as well as the lost opportunity cost of any of the money that you paid into it, as well as you lost the death benefit because you didn't die.
Well,
I still consider that a win.
totally. Oh, yeah. I mean, honestly, if you're alive, you're winning. I agree with that statement. But let's talk about those costs, because that's the one that most people are going to have specifically the sound arguments for. So if you have term, you're spending, I mean, tens of dollars. Let's say you're spending $30 a month. You take that difference, let's say instead of spending $1,500 a month for a whole policy, so you take, I don't know, let's just say $1,400, and you take that, invest into the stock market, and get 10% return on average a year, hypothetically. What's the difference, or why would you do that versus taking, instead of spending the $30 on term, spending $1,400 for like a whole index or a whole life or universal variable policy?
Okay. Well, in traditional thinking, you should have a combination of stocks and bonds, correct? You should have different ways of looking at what you want to do. You need to have some of your money protected, and you need to risk some of your money if you want to do it. You don't have to risk all your money. You don't have to be completely conservative with all your money. It depends on where you are. Everybody has a different approach. There are two types of wealth. There's statement wealth, and there's contractual wealth. A bond is a contractual wealth. You're paying money to an institution for guaranteed return and guaranteed benefits. The institution ultimately takes the risk, but gives you the benefits for it. And in the long run, you get money. Whereas statement wealth, you buy stock, you sell stock, you do different investments, and you end up with a statement. There's a chance of risk, there's a chance of loss, there is a chance of great gain as well. But it's the old eggs in one basket kind of thing. Nobody should have necessarily all their eggs in one basket. So if you do a 30-year, let's say you do a 20-year term policy, let's say you're age 35, give or take, it's going to cost around $500 a year. Okay, so at the end of, let me see, I'm going to pull this up, see if I can do this here.
What was that? I'm sorry?
I'm pulling up a calculator real quick.
Okay.
So, all right, we take $500 a year, and that's what your premium is for 20 years. All right, you've spent $10,000. Okay, well, you didn't, at the end of that 20-year period of time, you didn't die. So you have a lost opportunity cost to calculate. First and foremost, let's say just an average rate of return of 5%. Well, your $500 a year at a lost opportunity cost, that equals $17,359. It's lost opportunity cost on that money. You couldn't use that money to invest. Well, at the end of that, you also didn't die, so nobody sees your $500,000. You don't, and your family doesn't. Well, let's say if you had died, they would have gotten the $500,000. Let's say that's at an average interest rate. And let's say they would have been able to use it for another 20 years. That's $1.3 million plus that never came into your financial world because of that. Again, it's not bad. It just means that you used a portion of your money to cover yourself. Most people don't actually do the buy term and invest the difference. Most people will say they'll buy term and invest the difference. Most people do one or the other, very rarely do both. And it's not a common thing. Also, less than 4% of term policies ever actually pay out. It's actually around 1%. So it's almost a guaranteed loss. If that's the case, well, you could just invest all of it. But what happens if you die before then? That affects things. You don't care, you're dead, but you probably care about your family.
Yeah.
If you look at permanent policies, let's take that same example. 35-year-old. Let's say it's a $500,000 death benefit, same death benefit. A permanent policy would be somewhere around, let's say, $6,700. I'm looking at one I just pulled up.
600-700 a year.
That's correct,
Okay.
$6,700 a year. Now it sounds way more costly than the term policy. Obviously, there's a lot higher premium. Well, the cash value in this is growing. You're getting a rate of return internally of about 4%. By year 3, your cash value is $8,400. You're still putting in a premium of $6,700, but you can take out, if you've got $8,400 in cash value, you can take out $6,700. Well, the next year you're paying in $6,700. Well, the cash value is 15. You can still take out another $6,700. You still have your death benefit. The next year you've got $21,938 cash value, but you could take out $6,700. So there are multiple ways to look at it. And if we were to just take that same 20-year period of time, so 20 years at 67, you've paid in $134,000. You didn't spend $134,000, you paid it into it. It's a premium deposit. Cash value in that policy at year 20 is $155,000, and your death benefit's $636,000. Plus you've got tax-free dividends of $3,900.
Right. Yep. That's interesting. That is very interesting. And like I said, is it true or false that when you hit that 20 years though, can you still keep that policy open and active?
You can. With a term policy and with a permanent policy, you can. With a term policy, your premium is going to skyrocket. Year 21, your premium is probably going to be around $13,000 a year.
Okay.
Because what you're doing is basically you're leveling out the cost over a period of time. Well, a 20-year term, it's leveling it out over that 20-year period of time. And then it becomes what's called annual renewable. So each year you have to pay a new premium for a new policy of $500,000. Almost nobody ever does it. At the end of year 20, if you've been paying $500 a year and suddenly your premium is $13,000 a year, are you most likely going to pay for that policy or not?
Right.
Most people don't. Almost nobody ever does. So they're just no longer insured and they got no benefit from it.
So the big question, I mean, a lot of it's going to come down to discipline, I guess is kind of what you're saying, because if you do have the term and you are, if you're healthy, you probably want to have a little bit of both. You probably want to sprinkle in a little bit of both, I guess is my thought.
Well, the ideal, you want to have, I normally maximize on myself. I maximize the amount of whole life that I possibly can because I'm getting contractual growth at all times. Mm-hmm. I also, when the market's down, all my clients were in great position. They had a great amount of pools of liquidity that they entered the market in. This is a great time. When the market drops, you buy. So if you have a pool of liquidity you can take from, you have different ways of doing that, different ways of accessing it. And if I lose that money by some chance, I still have the death benefit. It's not either or.
Interesting. Okay, so that's a good point. So when you're talking about the pool of liquidity, you're pulling out that cash value that you were able to build up over a period of time, and you can take that cash value, like we mentioned at the very onset of this part, you can use that to invest it in stocks. Let's say all that goes bad and you shit the bed and you don't do really that great, and now everything's not that phenomenal and you lost it. You still have the death benefit, even though, or at least you have the death benefit minus the cash value, right?
Correct. Yeah, we have to look at things as though you're a business. Everybody in this chat is a business. Every single person I talk to is a business. Whether it's just a family working a regular 9 to 5, whether it's somebody trading professionally, whatever it happens to be, you are a business. So you have to think as a business. No business risks, very few businesses that succeed risk everything. What they do is they protect their assets. They make sure that they have the ability to continue to create revenue, but also protect their company from going under if something happens. Most large companies and a lot of small companies have insurance called key man insurance on the top producers in their company or the CEOs, because if something happens to somebody, we need to be insured to take care of that situation. A lot of companies can actually use that as a pension. Pensions have gone by the wayside. It used to be a company putting in money for somebody else on their behalf, putting it in the market. Well, technically, that's what you're doing with your life insurance if you buy a permanent policy. You're allowing this huge company with huge amounts of assets. Life insurance companies are typically the most wealthy companies in the market, mostly because nobody ends up getting their term policies paid and they've just made pure profit on it. So they take this money and they're investing it. They have teams of investors, whether it's in real estate, whether it's in the market, it's in normally multiple things, including bonds. You're letting them take the risk on a portion of that money while protecting yourself, and you still have the ability to go do what you're doing.
Got it. Well, what's good is this is raising a lot of questions in the chat pane, which is nice. So let me get to one of them or some of them. So I have a gentleman saying, and you can read this too if you need, but he's saying, can you take the balance of a home sale over the $500,000 capital gain free for a married couple and invest it in a universal or variable to avoid capital gains on the remaining profit?
That's a complicated one. I'd have to look at it. It depends on a lot of different situations. That's going to get into very, very specific situations. It depends on what all's going on.
Yeah, which makes sense. Because a lot of times it's going to be more of like a 1031 situation, Lottie, to avoid that. But there are situations where potentially it could happen. So great question. Definitely good question. Another one, Lee says, I heard whole life insurance is the tax shelter for the rich.
Yeah, that's an interesting way of putting it. Yeah, you'll find that most wealthy people do cover their assets with whole life. And here's the reason. There are several ways to look at it. It depends on how benevolent you are or just what you want to do in life. So everybody's heard the term trust fund baby. Okay, so here's how this works.
Okay.
Let's imagine I have $20 million in assets. Okay, I insure myself with whole life for, if not all of it, at least a portion of it. Let's say the whole amount at this case, $20 million. So I have a $20 million policy on myself. At death, I have spent all of my normal assets. I spent all 20 million of my assets having a ball, doing whatever I wanted to do. At death, $20 million tax-free comes in, instead of having to worry about an estate tax on the assets. $20 million comes in tax-free into a trust. The trust now doles out that money to the children and buys life insurance on them for that amount. They die eventually, having spent all the money in the trust. The $20 million policy fills the trust back up for their children. That's why you typically see people who are wealthy stay wealthy for generations. It's one of the greatest, easiest ways to transfer wealth tax-free. I mean, it is a tax-free asset, so you get to do it. And that's just if you end up passing it on. I can show people, and I have shown people multiple times, how to spend it. I don't have children, which means I can spend my death benefit while I'm alive. There are ways to do that with a whole life policy. I can leverage against it. I can sell it.
Yeah.
I can assign it.
Yeah, that's something that a lot of people, I was shocked when I heard that you can sell or assign those policies as well if you want. I mean, if you wanted to.
Yeah, if I've got a $2 million whole life policy and I'm 70 and I just want to go all out and have a, I don't know what exactly I'd be doing at 70. Maybe I'll do
well,
dance myself to death or something. I don't know.
Yeah.
But I can sell that policy to any company that would be willing to pay for it. I'll say, look, give me $1 million over the next 8 years. I will sign this $2 million tax-free asset over to you. Who wouldn't pay $1 million over that period of time to have a $2 million tax-free asset come into the books?
Yeah. Yeah. I mean, why would you not?
That's right.
Yeah. So Thomas has a question. Well, he has a statement. He says, my perspective, at some point, some level of wealth, it's not about the complete optimization of rate of return, but more about sustaining that wealth and possibly creating generational wealth.
Exactly. That's again on the topic of the trust, just as an example.
Yeah. So Lee's asking the question, do parents buy whole life insurance for their children? And I'm going to say yes. I do. I can. I know you are able to, but you fill me in. Am I wrong on that?
I wouldn't say you're wrong, but you typically want to use the life insurance for somebody who has economic life value. I'm not saying everybody knows our children have values. They have a value to us, but they are not producing. They are not yet a business. They are not producing revenue. At that point in time, most people who buy life insurance on their children, it could be if they're concerned about if a child dies and it's for funeral costs and things like that. Because obviously you're going to be out of the picture for a while if your child dies. There's opportunities there to cover your losses. It's rare. That's not something that I would focus on typically. I'd rather put that money on a parent or on myself. The goal is to leverage your money. The whole goal of leverage is to use a small amount of money to create a large amount of money in a short amount of time.
Yeah.
That's not a child.
Yep. Got it. So what the heck is the difference between a whole life policy and an annuity?
Okay. So annuities are owned. They're a product of and typically owned by life insurance companies. So it's basically on a whole life chassis. So they look at how much money you're putting in, whether it's a lump sum, your life expectancy, because I'm going to digress a second. When your death benefit comes in to whomever the beneficiary is, the beneficiary does not have to take a lump sum cash tax-free payout.
Right.
They can keep it with the company, and that life insurance company can continue to invest it and give a rate of return. You can live off of the rate of return. You can live off the dividends. You can do a period of payments. I want all the money to come out over a 20-year period of time. That's a good example of a trust. You know, if you have a minor, you don't want all that money to come out right away, so you can dictate how that money comes out. Annuitizing, or having an annuity that annuitizes, takes whatever value is in there based on what you've put in and what their expected growth is going to be of that account, and pays that to you as income over a period of time. You can choose lifetime income. So they'll calculate based on mortality tables how long they think you're going to live, and it becomes a gamble.
On their part, yeah.
That's right. So either they're going to end up paying you less and they get to keep the difference, or you live longer than they expected and they paid you more than you put into it. But it's all based on the same type of process. And there are multiple types of annuities. There are indexed annuities, for example, that mimic the market. You can end up with an annuity where you put in money, it actually follows the S&P 500. Yep. Any growth that the S&P does, you have different ways of gaining that growth in your annuity. There are guarantees of no loss. So if the market goes down, you don't lose. You've only gained what you've gained. So it's a one-way growth. There is no loss.
Got it. Yep. Very interesting. And again, if anyone else has any questions, feel free to throw them in there. Some of these are mine, but I mean, here's the first one that came to mind when you were talking about the term and the whole. I mean, why is term so cheap? I mean, because again, I think for me, having a blend where you go, all right, here's a little bit of term just in case. It's super, super cheap. Yeah, I'll invest the difference. I'll have a difference. But then having a whole index life policy that is, you know, I can't lose, right? You can't lose on the interest on that. So you're only making 0 or 1%, but you can't lose negative. Or you make some type of cap percentage. So let's say 7 or 8%. That's your max that you're going to make that year. And just kind of blend it out. But why is term so cheap, man? I mean, for a $500,000 death benefit for $20 a month seems small.
Right. And again, understand when I talk about these different things, I'm not knocking one over the other. There is a place for term. I think it is good. If you cannot necessarily afford to do whole life insurance and get the returns within it, as well as make sure you have a permanent policy, at least having term is beneficial. Sometimes key man insurance term is beneficial. You can use term to cover a mortgage on a business. There are different ways. There are reasons for it. What I would say, I just derailed myself. I apologize. So the reason term is so inexpensive, let me ask you this, kind of as a way to describe it. Mm-hmm. Would you invest in a stock that had a 1% chance of paying out?
No.
Right. What company wouldn't want to offer a product where they only had to pay out 1% of the time?
Gotcha. Yeah, I mean, I get it. Makes sense.
That is the number one reason why life insurance companies have the amount of money they have, is because it is almost a pure cost to whoever buys it. Again, there are benefits to that cost. Sometimes it's worth it. Sometimes you need to do that.
Yeah,
Sometimes you don't. Sometimes you care. Sometimes you don't. Some people just don't care. If I die, I'm gone. Doesn't matter. Everybody else will survive. Que sera.
got it. So that's the least costly life insurance is term?
No, in the long run, I would not say it's the least costly. It's 100% cost 99% of the time.
Mm. Okay, yeah, okay. I see where you're going.
100% of the time, whole life insurance is going to be the least cost at the grand scheme of things, because no matter pretty much any situation, it's going to pay out. It's a permanent policy. You can even do a reduced paid up policy where you're no longer paying the premium. Unlike term that just dies, whole life, you still have a death benefit on the books.
Mm, got it.
And it still produces cash value. It still maintains the growth rate on the cash value, and it still produces income tax-free dividends.
Yeah, yeah. No, this is interesting, man. Again, that's why when you're kind of explaining the differences, I was like, I just appreciate the way you explain things. Step into one, if you guys are feeling me on that. I just feel like you have a good teacher's mentality on this, because let's be honest, man. Insurance is so confusing sometimes.
Well,
And
it is. Well, it's an important tool that has the worst name in existence.
yeah,
Nobody wants to think about life insurance. You can literally you can walk into a crowd full of people and say the word life insurance, and you watch people's eyes glaze over. It's not an exciting topic because people think of it as death insurance.
yeah.
This is only one. Literally, we work on all 27 components of a person's financial world. This is literally one component of all 27, but it's an important one because
How
you
many
can use it
components are there?
to 27. Well, 28 actually.
Give me a quick rundown of what those are.
Sure. All right. So you've got vehicle insurance, property insurance, liability insurance, disability insurance, medical insurance, government plans such as uh, Social Security, wills, trusts, life insurance, checking accounts, saving accounts, credit unions, savings bonds, CDs, money market, tax deferred accounts, tax-free accounts, tax deductible accounts, government bonds, corporate bonds, municipal bonds, preferred stocks, blue chip stocks, growth stocks, collectibles, real estate, tax shelters, and debt.
Boom.
That pretty much covers every possible thing your money can be in.
Dude, let's make that a rap song. That was fired me up.
It's about as much rhythm as you're going to get out of me.
That's it. That's it. I love it. Very cool, man. Well, so there was a question that Thomas had. So he says, in the trust fund situation you mentioned earlier, how often do people that buy the whole life policy buy a completely paid up policy with an upfront premium?
I would say that I see that maybe 10% of the time. Reason being, there's still other things you can do with that money. Why? You can put all the money in there up front, and there are ways to do that for multiple reasons. You can overfund. If you overfund, you build your cash value faster, which is oftentimes what you see in the infinite banking concept. You overfund the policy so that you have more cash value to use. You basically turn your life insurance policy into a bank that you then pull money out of. If you're going to get the death benefit immediately, for example, that $500,000 policy I was talking about, if you pay $6,774 and you get $500,000 tax-free asset on the book immediately, why would you absolutely pour all of your money into that right up front and take it away from use to do other things instead of pay an annual premium or a monthly premium and have a lower cost for that same benefit? It depends. And because what I do is so thorough, as you can tell, considering just this one component we're talking about, because what I do is so thorough, everybody's financial world is different. What I would do for Thomas versus what I would do for Jeremy versus what I would do for myself is going to be different. It's everybody's situation is completely different. But you have to look at the whole picture.
Yeah.
You can't look at one puzzle piece and immediately go, oh, I know exactly what this is. You have to look at the whole picture if you're going to make sure that the whole thing works.
Yeah, agreed. Because again, there's no perfect exact solution for anyone, for everyone. And so Deepak, to answer your question, Deepak's asking like, how much would it cost for $500,000 of insurance? I mean, the thing is, man, it depends on your age. It depends on your health. It depends on your income. Because again, I mean, the more you have, you can buy more insurance. The
Correct.
less you have, you buy less insurance. There's a lot of different factors. So we'll talk about how to ask Michael very direct questions in just a moment. A lot of questions are pouring in the chat pane, which is, again, this was my goal of this, folks. I hope everyone knows that. Is I wanted to open up just a nice roundtable discussion with someone that I personally trust, that I have business with, that I pay money to, or paid. I don't think I've already done it. But anyway, I wanted to open up a discussion so that we could all just kind of get more information. I've done this with real estate professionals. I've done this with tax professionals. I've done this with a lot of different professionals, a lot of different expertise. So let me answer or ask another question that was in the chat pane. Lee says, is it correct that if we reach a certain age, we cannot buy any more term insurance?
That's correct. There is a point where they just will not insure you because they know that it's a cost value analysis. Currently, because we really don't look at buying term insurance on people who are elderly often. I don't know that age, but I can look that up real quick. I think it's 80.
Yeah, because over a certain amount, like I said, they know at this point so far, 100% of people die at some point.
Right.
So they're not going to want to lose money on you.
And also it can depend on some insurance companies. Some are willing to take more of a risk and are able to do that. So it depends.
Yeah, makes sense.
But normally it's in your high 70s to early 80s that they just won't do it anymore because it's not going to be beneficial.
Right. But again, I mean, term is going to go up exponentially as
the cost is going to be outrageous.
Yeah, cost is going to be extremely, extremely high. Diane says, what are the advantages to the universal insurance? We haven't really talked about that one. What are the advantages or disadvantages? Because I have a few friends that don't like it at all.
Right. The one major advantage to universal life is normally somebody who's less insurable or less likely to be insurable. Oftentimes you can get universal life on them where you can't elsewhere. If I can't get a permanent policy for a client due to some health issues, I will then look for universal because it would be the next down the list that I would look at. Benefits to it is, again, you have cash value. It is a term policy. So what will happen is, what's funny is if you look at a normal term policy contract, it's about 3 pages. If you look at a universal life insurance policy, oftentimes it's about 47 to 70 pages long because they have a whole lot of caveats and if this, then this, and what about this? The benefit is you still have cash value that can grow in it. You still have access to that cash value. You have the ability to keep it potentially for longer than what a term policy would have covered, because what happens is the cash value in that policy, whatever is in that pool, can be used to cover the difference in cost in the term policy that is the chassis. So at the end of, say, 20 years, as that policy starts to go up in cost, they would use a portion of that cash value, however much there is, to cover the difference so you don't have to pay more out of your pocket.
Mm. So, I mean, in what situation do you think, just as a broad brushstrokes, would a index universal life fit for most people?
Is it? I'm sorry, repeat that question for me. I'm sorry.
So in what situation do you think an index universal life policy would fit most people or a particular person?
I don't think it would fit most people. It's not, again, it's better than nothing, but it's not the first thing I would look at.
Got it.
It would fit people first and foremost, like I said, basically if they might have some health issues. If I end up with clients who end up with cancer diagnoses or went through cancer or went through heart attack or something like that, they're less likely to be able to be covered under a permanent policy or under traditional terms. So you look at universal potentially.
Got it. What type of insurance is affordable for people in their 60s? If you're talking about as we get later, as in the situations, would universal be something that you would consider more of?
Well, it all depends on their health. It depends on what their assets are. It depends on their income level. I had a client just recently that she is 72, and we went through the different options, and we ended up getting a permanent policy. It made the most sense because she wanted the tax-free asset to come in on the estate because they had a very large estate. So the more that they could transfer tax-free as opposed to taxable is beneficial. It was guaranteed, so that's beneficial. Also, if people are healthy, often you can get 2 riders on a permanent policy. You can sometimes get them on other policies. It depends, but they're sometimes more difficult. On a permanent policy, you can often get long-term care riders such as chronic illness and terminal illness. So basically, if you become chronically ill, you get access to the death benefit while you're alive. If you become terminally ill, you get access to the death benefit a lot while you're alive. She was concerned that she would end up in a situation in the near future with possible dementia. And if that's the case, she didn't want that to eat away from the estate. So instead of it eating the estate, it's going to eat the death benefit and not touch the estate. So it actually allows for more estate passage.
Gotcha.
That's
So
something important. You got to think, a lot of people nowadays look at buying a long-term care policy. Well, some of these policies have that in them. Now you've got, somebody turning 65 today has almost a 70% chance of needing some form of long-term care.
yeah, I
So
agree.
it's
But you're
another
definitely
way
not
to.
getting that with term.
No, exactly. So you get all these. It's the ability to use your dollars more than once. You guys are
Yeah.
using dollars every single day, but when that dollar is in that stock, the only way you're going to get the growth is if it stays in that stock.
Yeah.
This allows us to turbocharge options. It's kind of like a turbo on an engine. If you put money into this policy, you get death benefit, you get growth on the cash value, and you get to reaccess the cash and use it again while maintaining those benefits. You're now using that dollar more than once. You're acting more as a business.
Got it. Yep. Lottie says, this is such a fantastic discussion. I appreciate it, Lottie. And again, that's my goal, is just to get information and insight from other people who are smarter than me about things that I know nothing about. So this sums up all of those things. I'm just trying to scroll through the chat pane really quick. Okay, so Lottie says, if you've been paying for term life insurance for, let's say, 15 years, has it vanished or can you do anything with it?
Well, whatever premium you paid into it has vanished. As far as the death benefit, it depends. If it's a 15-year term policy, at the end of that 15th year, it cancels, you have no more death benefit, and your premiums are gone. If it's a 20-year policy, you've got another 5 years. There are options in some cases where some term policies, some companies will allow you to convert an existing term policy into a permanent policy.
Yeah. Interesting. Well, here's the thing, man. I'm actually getting too many more questions in the chat pane that I can really answer. Is there a way specifically that you would prefer someone to reach out to you if they have an exact question and they want you to kind of review what their questions are and what might be best for them?
Sure. Yeah, my email is, I'll type it in here. Hold on a second.
Yeah, throw it in the chat pane and I'll post it up. So if anybody wants to email Michael, you guys can. All right, so perfect. So this is Michael's email address. And is that the preferred method for contact?
Yeah, that, and honestly, it would be a good way to start into a phone conversation. I can set up a time where we can talk, because obviously there's a lot of questions that come with this.
Yeah.
And in order for me to give a good answer, I need to understand what's going on.
Tons. And I will be, again, guys, very clear with Michael. Like, he came over to my house when we were doing some of the insurance policies that I needed for some specific things I was creating and crafting. And I think he came over 2 or 3 times and we went through all kinds of stuff, questions, Q&A. I don't live in the most convenient part of town. So, I mean, he drove over, we sat down at my table and filled out a bunch of paperwork, and he was asking a bunch of questions and, income and stocks and time frame and age and health. So it's obviously variable. It depends on your situation, depends on a lot of things. There's never a blanket statement for anyone other than the statement of, money does matter. And if you want generational wealth, if you want to be comfortable, if you want you and your most precious belongings, which I would agree is your family, you're going to have to think through and discuss and talk through how you can best serve them. So make sure that you get some information. So yeah, Michael at sandawealth.com should take care of it. And yeah, if you email him directly, guys, just schedule a phone call. That's what I did. Schedule a phone call. It was like 10 minutes. And then just because I'm in Nashville, Michael came over to my house. He's not going to come over to your house if you live in California. At least I don't think so.
Good excuse for a vacation, I guess.
Yeah. Totally. But again, in the same instance, yeah, if you guys have any questions, just email Michael. I'll make sure it's in the description box. Terry says, where's the email? Let me put it in the chat pane again. I'll also put it on the, are you able to see my screen, Terry? I don't think I have it paused. So if you, Michael at sandawealth.com, if you have a question, just shoot me an email. Any other last minute questions for me? Do you have any questions for me, Mike? I mean, you're watching us day trade. Anything that jumped off for you?
I was just trying to keep up. That's a lot of stuff to deal with in an individual situation like that. Obviously in what I deal with, I deal with a lot of long-term things. This is like boom, boom, boom. It's very interesting. I'm fascinated by it.
Yeah.
I'm definitely looking forward to learning more about it. It's
totally,
definitely a feather I do not have in my cap.
Hey, totally. I mean, the best way I could possibly the way I break it down for people as quickly as I absolutely can is, let's say we're looking at AMD. You know what this company is, right?
Yeah.
Yep. So AMD microprocessing chips. So if you were to buy, let's just say 100 shares at this blue line, which is 49, and then you sold those exact 100 shares at 51. So you bought 100 shares. AMD moved $2 in the last hour and a half, 2 hours. That would have been a $200 cash flow generating trade based on some relatively interesting, pretty specific signals. So 49 to 51, $2 on AMD, one of the biggest companies. Well, I shouldn't say the biggest in the company is in the world, but the best performing company in the S&P 500 last year. You know, trading this one, buying it at 49, selling it at 51, and that will work with any amount of math. So if it's 1,000 shares, you make $2,000. If it's 10,000 shares, you made 20 grand.
Mm-hmm. Okay.
So that's kind of day trading. And then of course, if your goal is to make $2 and your risk is 50 cents, you know, at some point it's just pretty basic, simple math, right?
Yep.
Heck yeah.
Makes sense.
Yeah, man. But again, folks, that's going to be what me and Michael are going to do. So you guys reach out to Michael and ask him any questions you guys have. Set up a consultation if you want. You don't have to. I'm not going to get paid regardless. So it doesn't really matter. I don't have an insurance license. So you can do whatever you want. But then, you know, Michael and I will be working together and I'll help him learn to trade. And it's all about growing and using your skills and your assets. I've dedicated 11 years to figuring out this stuff. And I think that was a really informative presentation and discussion. So Michael, man, thank you so much for your time. I really appreciate it.
Jeremy, absolutely my pleasure, man. Thank you for having me. And everybody, thank you so much for listening. I really appreciate it.
Yep. Absolutely, my friend. Well, folks, there you go. And again, if you ever have any particular topics or information where you're like, I must need more information on this. Again, my friends, I am not afraid to reach out to anyone and ask them about anything. So you're always welcome to reach out and connect with me and tell me who you want to be to get on the show, and I will do my absolute best. But thank you all for being here. I really appreciate your time, your energy, your enthusiasm, and thank you for helping me enrich lives. Ladies and gentlemen, it's been a phenomenal week. Today is Wednesday, most certainly spelled with an I. Wednesday, powerful house, powerful day out there in the markets. You guys all rock. I'll see you later, and until next time, love life, and trade it. Bye.